All right, stocks continued late day rally from Friday, continued on into today, despite a little bit of a drop in Bitcoin over the weekend. So we're going to take a look at today's rally and see, okay, is the sell off done, or is this just one of those up days and a downtrend? So we're going to kind of look at it from the perspective of that kind of post Thanksgiving move that we've been on. We're going to take a look at some different indicators to see if they've broken back up to the upside, and then that will kind of dictate what we expect to see the rest of the week. Obviously, if we're still in volatility mode, there'll be some choppiness. If this broke out to the upside, then we should expect to see a lot more up days this week, and volatility really to decline back down relatively sharply to the downside. So we'll take a look at that. We'll also take a look at our trade idea of the day of a stock that's bounced back itself really sharp. It's been a really beaten up area that's bounced back. So we'll talk, but still kind of on a downtrend. So we'll talk about how to trade that, taking advantage of a big bounce back, but still a very strong downward trend. What kind of trade do we make in that situation? We'll take a look at that. So let's go ahead and get started. Today is Monday, December the 6th, 2021. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the market forecast indicator with the on the S&P 500, and you can see we're back above that 38% retracement level, not quite back above the 23%. Remember, the retracement begins when you break below the 23% line. It ends when you either break back above it, we go back higher again, or you break below the 78% line and we get going to the downside. So we are back above the 38%. It was a good rally at the close on Friday. It's continued into today. It's brought the near-term line up out of bearish territory, and the momentum line for that matter too. Now the question is, where is that near-term line going to peak? Right? If it peaks here, if it peaks just a little bit above 60, if it gets, that's not necessarily the best peak. If it can get above 80 and especially above 90, now we're talking about a change in direction. Again, probably back above that 23% line, and here we go again. But as of right now, still in relatively bearish near-term high territory. So keep that in mind. Let's take a look at the Dow Jones Industrial Average. And you see it very similar, except it is above 80. You can see, remember, it had dropped below the 78% line, and then the last 3 days have really rallied up to about the midpoint of this decline. So now the question is, is this the peak, the near-term peak for the Dow? Are we going to roll back over after getting an oversold, or really close to an oversold cluster back last Wednesday? If you take a look at the NASDAQ 100, its near intermediate line has not dropped yet into bearish territory. We do have dark pink shading. We are below 50, so we have dark pink shading yet. We don't have a red line yet. Obviously, we are below the 23% line. We did not get back above the 38% like we did on the S&P. And then finally, the Russell 2000. It's still below that 78% line. Unlike the Dow, remember the Dow dropped below but then got back up. The Russell has not. So you're still strongly bearish. Your market sentiment line's almost below 60. The near-term line did get out of bearish territory, but now the question is, where is it going to peak? And as of right now, that's not necessarily the best spot, the best area here. So you get a day like today. I've always talked about you get good 1% moves to the upside, but you need more than you need a bigger move, right? That's what ends the bearishness, is when you get these bigger moves to the upside. If I were to go back a few years, you can kind of see when these intermediate declines end, right? You get these bigger moves to the upside. Here's that September, October. You get a good strong 2% plus move, and then we just stop going down, right? Well, that's not the case here. This is just a less of a move than we got last Thursday on SPY and IWM. It was a pretty decent size, but again, less than what we saw last Thursday and about the same as what we saw to the downside on Friday. So, it's a great up day, but like I've always said, you get your biggest up days when you're on when you're below moving averages, and you also get plenty of up days during intermediate declines and market sentiment declines. They need to be more significant than this if we're going to really kind of break the trend and call this a runaway gap. We'll take a look at that chart here in a second. So not quite there yet. Your long-term crossover, the S&P did get a green arrow again, so that's a relatively good sign. We still have a negative differential, so we're not back to positive yet. We're still falling in the PPO, so we're quite there yet. The Dow Jones still is red. It still has the red arrow, and everything else is still bearish. Here, let's go Dow Jones, and then finally your Nasdaq 100 also has the green line, but the bearish differential down there and the falling PPO. And then your Russell 2000 is still flirting with the 200, the 40-week exponential moving average. So, and still very bearish. Like, we don't have upper shadows on any of these yet. So not quite a turnaround. Though you are in bearish convergence mode. You can see you have the histograms are all rising. See how they're all rising here. None of them are red. We're still dark pink shading, so we still have 3 red arrows. But the histogram looks like it's relatively close on all of these, and the stochastics here on the diamonds to getting us one green arrow, right? So you know, a good update and a bearish move, but not necessarily a trend-changing update. At least not yet, right? I mean, you look at, you know, we're still below the 17-day moving average, so that's still, I mean, we're still actually in bearish divergence because we're not above the moving average on the MACD yet. The diamonds is also still below its moving average, so it's, you can see, kind of got back above the point of control after flirting with the 200-day. You were right back up to the 50, and back above the point of control, and this a relatively bullish close there above the 17-day, but not the same thing for the Qs. Still in bearish divergence mode, as well as IWM still in bearish divergence mode too, and still below the point of control. Still below the 8-day moving average. So the Russell 2000, as you know, 2% rally only got you to just a little bit below. I mean, well, pretty decently below the 8-day moving average. So, you know, again, a good update and a bearish move, but not a trend-changing update. For what we're seeing here, you know, your negative indicator on the S&P fell, the DMI indicator fell, but not the positive indicator did not rally. If you look at IWM, you know, we're still above 25 on the negative and still well below 20 on the positive. So we're hardly changing. Diamond, remember, is the most bullish. It's also still above 25 and below 20. So the bearish move hasn't ended, according to the DMI indicator. If you look at the trend strength indicator, you remember your S&P had ended and the Qs had ended their bullish run. But you remember your diamonds and your IWM are on bearish runs. We got back to the blue line on the diamonds and back above the cloud there, but still below minus 2.0 and still above 65. So we're still got an intermediate bearish trend on those noise indicators down there, trend strength indicators. You're still above 80 and just barely below minus 5. So you actually still are really close to a very mature bearish trend, and you're still below the cloud on IWM. So hardly a reversal, right? This doesn't look like a reversal type pattern. Looking at the RSI, you are still in the lower half of those charts. The Russell 2000, you're still in bearish territory, right? You're still easily below 0, and you're still easily below 40. So not quite the change there either. Looking at the Bollinger Bands, your SPY is back into the middle of the bandwidth, but not into the upper half, right? And then IWM, you got this great bandwidth, great breakout going on right now, but you're just barely out of the lower quartile. And if you look at the where you're at with it, you're just barely above the Keltner channel. So you still got some bearish momentum. Your Bollinger Bands are still outside the Keltner channels. There's still a pretty decent gap between the Keltner and the Bollinger Band, so it's still a really good opportunity for us to continue to trend down. So I wouldn't necessarily buy into today's move as a move that ends it. You know, the close on Friday had the potential of like if it closed Friday like it did on Wednesday, then we probably would have followed through with that with a lot of bearishness today. So we avoided that with a good rally. And so that continued today. And so now I expect that we'll probably continue this bearish trend that we're on right now going into tomorrow and the rest of this week. If you look at the 4-week range here, you can see there's a gap down there. Not very much of one, but there's a gap, and we filled in a lot of it on SPY from the get-go. You can also see, too, that we filled in a lot of the gap, you know, from the get-go on IWM as well. So no runaway gaps here to change. Only the diamonds did not fill it in. So, you know, that has the potential of being a runaway gap, especially with the higher high, higher low, and closing nearly above last week's high point. Now the question is, will that hold, and will we come back and fill in that gap? That's actually my expectation of what I'm expecting. IWM, you notice, pretty much was the same range as what we saw on Friday. Slightly higher high, slightly lower low, but closed below Friday's high point and still easily below last week's high point. SPY, you can see, again, slightly higher high and much higher low, but closed below yesterday's high or Friday's high as well as last week's high. So not necessarily the most bearish patterns there. Looking at today's volume and trading range, again, we filled in the gap, so we're just barely above the average. Remember, after getting a really significant, like 11 points there on Wednesday, was 14 points. So 11-point range on Friday goes down to a 7-point range today. The volume on Friday goes from, whatever that was, 137 million down to 97 million. So those numbers aren't necessarily like, again, you had a big down day, you have a bounce back up day with much smaller numbers. 97 and 7 points. So 7 points is barely above that average. 97 million is actually down here. Oh, I said down. It's actually right here. So it's within the chart. So not necessarily the greatest bounce back there. You would have expected and hoped, if we were reversing here, to get a much bigger range and a much bigger amount of volume, at least proportional to what we saw on Friday, and then it starts to start to work its way to the downside as we establish the upward move. We've come down on volatility, which is not surprising. We typically always do on Monday anyway, but with the bullishness, we're at the 95% mark. Now the question is, will that hold? And when we make another run, this time from 95 up to 105 or higher. So that's really important to watch over the next few days. My expectation is that we will, that volatility will make a jump up to 105 or so. Obviously, there probably needs to be some kind of news factor, but from a technical perspective, today's if we don't follow through with today's move with some more bullishness tomorrow, Wednesday, to kind of break this downward momentum, then I expect momentum will actually continue to the downside, because today's move wasn't enough, wasn't big enough, wasn't strong enough. It was a typical bounce back day in a bearish move, and there wasn't anything about it that would suggest that it can break, that the bounce back was strong enough to break the momentum on the downside. When you're bearish, we don't go down every day. I hope everybody knows that. We don't go down every day. In fact, you have your biggest up days during bearish markets. You don't get 1% rallies typically during bullish markets. Generally speaking, you get some, but just a smattering, a handful. But during bearish moves, pretty much every up day is a 1% plus up move to the upside. So that's what we got today, and we don't put a lot of stock into it unless we get some follow through. I think it's lower probability that we'll get follow through on that. I think the higher probability, and where I lean, is that we'll continue with the bearish momentum to the downside. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, and you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Also, comment down there. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching our video on our blog here, come over here on the right and check out some of these other things. Click on this icon right here that takes you to our Market Outlook live page. Here you can review videos where I review all the Market Outlook trades. I do these on Monday, Wednesday, and Fridays at 3:30 Eastern time. It's on this page is where you can watch it. You can also see all the archives right here. You can also get to it by clicking on Market Outlook Live Trade Review underneath Market Outlook. You can see our upcoming classes here. If you click View More, that takes you to our calendar. This is where our upcoming classes are, as well as all of our archives. You can also click on trading rooms to get to the same spot. Come down here at the bottom, hit that heart. It opens up this new tab. Right here, click that like button. Also come over here, click on this icon. It takes you to our Facebook page. Hit that like button as well. Again, the more you do that, it helps us get our content out to a lot of our followers. That's how Facebook and Twitter works. So that's why we always ask. We really appreciate those that click on that like button. Also, it helps you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here, so that way they keep showing you our content. All right, if we take a look at what's driving today's price action, you can see what's been doing poorly over the last 3 months. But really, I want to kind of go back to this post-Thanksgiving. Actually, I have to come down here to November. This post-Thanksgiving Friday move, declines that we've seen. And you can see small cap stocks, commodity prices, all really down quite a bit. The Qs were down, and then you have like bonds were higher, gold was outperforming, currencies are outperforming, corporate bonds outperforming. That was all going into today, and then now here is today's move. If I were to go over here to just today, so give me 1 second while I bring this up. You can see that those are the things that got raised, that rallied the most, and which fell. So I mean, it was basically just a bounce back rally today. That doesn't necessarily, again, change the trend. The things that were down the most bounced the most. Things that were up the most came down the most. And if you take a look at the 12 grid here, so give me 1 second to pull up the 12 grid for all the different areas. You can see there's still a lot of dark pink shading and red line here, a lot of it, no matter whether you're looking at copper or silver down here, whether you're looking at Bitcoin, which is now well below its moving average, or global equities here, or the 10-year yield, everything, whether it's US equities, the euro is dark pink shading and red line still. So the only thing on this chart that's showing us dark green shading and a green line, it still is long-term bonds, which is the safety asset class. And when you look at currencies today, so if I were to take a look at all the major currencies that are out there, here, let's just go to since November, since the November 26th time frame. Up until now, you can see the franc and the yen has been really bullish. You also have the South African rand and the Mexican peso, your commodity currencies really struggling, and the dollar is also lagging behind these other safe haven areas and lagging behind the euro. So that was going into today. Let's just look at just today. So we'll go December 6th here. And you can see the dollar still underperformed, but this time it's underperforming all the commodity currencies, and the pound and a little bit the euro, and the franc and the yen, your safe haven areas, were down the most. So it was a risk on day, but it was a risk on day to the tune of just a little bit of a bounce back. You see your bonds are still above their 8-day moving average. Gold is still trying to figure out what to do. It's still centered on that point of control there. If you look at the euro US dollar, let's just look at the dollar index, the ETF that tracks the dollar index. It's still above that 8-day moving average, but definitely in bullish convergence mode. Remember, the dollar's been so bullish during this rally and risk appetite. It's the euro that's been the more bearish one. And so the euro now is starting to show some strength, especially relative to some of its peers, like the pound. Right, it's finally bouncing back up above the pound, still below its 200-day moving average though. Big move higher against the franc today. We haven't seen a move above the 8-day moving average for a long time in that. And then you can see it's been kind of basing here over the last week and looking to start a bearish convergence with a little bit of a bullish divergence going on here against the yen. So the euro had been so weak, it appears that it might be starting to move a little bit higher. That's going to put pressure on the UUP because the euro makes up 60% of the dollar index, which is what the UUP tracks. And again, this has been bullish during this run on risk appetite. So we'll see, if that if a bullish convergence, if a bearish divergence coincides with a little bit of a move and a risk off. If I were to take a look here at some of these charts, I don't think the skew's been updated yet for today. Oh, it has been updated today. So you can see the skew, the demand for far out of the money puts actually rallied today. So that's not typical, right? So we still haven't had the drop below the moving average, which is what it does when you start your decline. We're actually still well above that 30-day moving average. You can see the trend, which measures declining volume versus advancing volume. It compares that ratio to the advancers decliners ratio. It's still showing that decliners are getting more volume than advancers, especially relative to how many there are decliners versus advancers. If we take a look at the highs and lows, this one has been updated too. You're still 500 more new lows than we have new highs. So and the moving average for that index has gotten down to almost 250. Just for some context and what it takes for the average to get down there. So here's where the average is. COVID low, fourth quarter 2018, 15 and 16, and then October 2014. These are all market sentiment declines, where the orange line on the S&P gets below 40. So that's another indication I expect that we're not quite done here with the risk off moves. You can see some of these other patterns. This would be staples relative to discretionary. Big move higher the last couple of days. This would be a kind of a risk off pattern when this rallies higher and it's well above its 30-day moving average. Its MACD is turned positive. The PPO is turning around. Looks like it's about to cross. You got a really good, strong CCI that we haven't had for a while above 100. A positive DMI breakout there with a move higher on the RSI finally above 50. So not quite like a bullish trend, but you can see like the bearishness that we've had is pretty much over in terms of risk on, risk off. Let me show you. Let's take a look at the 12 grid for the sectors and how they performed today. So here's your 12 grid, and you can see still a lot of dark pink shading and a red line. If you look at the relative rotation graph for these sectors, here, let's come over here to the S&P sectors on the daily chart. You can see what's moving up to the right. Staples, real estate, utilities, energy and financials, healthcare. These four right here are your safe haven areas moving up to the right. Energy and financials have also been so beaten up. They're kind of like some value areas right now. Technology, discretionary, moving down to the left. Industrials, materials also down, and XLC in the lower left quadrant. So we have a lot of we have a move going on right now into these safety trades, and they've been so there's some rotation that can occur here. Here's the weekly chart. There's discretionary and technology. If you look at industrials, materials, there's discretionary, but look at utilities. It's just now turning up to the right. Real estate, just now turning up to the right. Staples, just now turning up to the right. So if we're moving into those areas, they've got some room to run here on the weekly chart for a while. When you take a look at how many stocks are above their 50-day moving average, there's a nice little rally here going into Friday. This hasn't been updated yet today, but you can see still well below the mean. So we are in, and we have been in pullback mode for a while here. We peaked on this back in April. We had a good peak to a higher high here in November, but again, being back below the medians, that's typically when you're on bearish runs, when you're below that median. So not really a good sign. There's been a lot of chatter about the put-call ratio. So let's bring that up here. Let's pull up the 1-year chart. The put-call ratio and how high it got on Friday. So here's that move that we're well up above. What is that, about up to the 74% mark, the highest that we've seen in a couple of years here. Give it a second to load up. There we go. You can see a good strong move. Last time we saw that was at the end of the intermediate decline in September and October. So very important to kind of watch the 2 standard deviations above the 2-year mean. And if I were to go back even further, just for some perspective, because this is kind of a new regime on the put-call ratio, that's still not very high compared to where it was previously, right? Before COVID really sparked this run on call buying. I mean, that's a high put-call ratio, but not nearly as high as what we've seen, kind of the norm So that's, again, that's because we have all this here. Let's go to a max on this chart. Let me refresh this page. We have this, large amount of call buying going on, and you can see not lately. I mean, we've really dived in the call buying here, and this again hasn't been updated yet for today. And there's been some demand in the dark pool, but not as much. If I were to go back out 2 years, we're not really getting, strong demand like you typically see, like over here when we were coming off of COVID. And then here's your September, October. You got some good demand that kind of sparked that post November move. So we're up at the higher levels, but we're not up to really strong levels that would suggest that this is kind of the low. The low has been set, similar to what we saw over here. When that low was eventually set just about a week or so later after that big spike in dark pool demand for call buying, for gamma exposure. All right, let's take a look at today's trade idea, and let's look at MasterCard. You can see that's our trade I wanted to look at. It's been on the bearish decline, not surprising. You had a big bearish move here that produced an oversold cluster. We've since really have snapped back from that pretty nicely, with the near-term line jumping for 2 days now up above the 90th percentile. So really good rallies. It's not been enough necessarily to change the bearish trend. We're not back above the 50-day moving average, but at least we have a transition candle forming there. If you look at the 2-line versions of the MACD and stochastics, you can see today's move got back above the value area after dropping below. Got back above the 17-day moving average, with the MACD and stochastics crossing above their moving averages. When you look at like some of these other oscillators, we're not bearish anymore. We fell below 25. We're above 20 on the positive indicator. When you look at the RSI and the CCI, we're back into the middle of the chart, so not in bearish territory anymore. When you look at the Ichimoku cloud, we got back above the green line, and we got back above 0 on the positive, though we're still really noisy. And you can see the red line is flirting with the price there. Let's come to the Bollinger Bands. You came from the lower end now to the middle quadrant, right to the middle. So very good sign with a very high bandwidth. So what I like to do in that scenario is I like to say, okay, well, let's take a look at selling an iron condor on this trade. So we can go and look at the 20 deltas and sell that 20 delta 370, sell the 20 delta 300, buy the strike away for protection. This is what it ends up looking like on this trade. So now if I set my slices to break even and set those slices to the charts, you can see where my break evens are. So if we continue to rally, I've got very strong resistance up where my top break even is, and my lower break even is down below that low point that we formed a few days ago. That really, when we kind of went semi-parabolic there, and came really close, or we did form that oversold cluster. So now if we continue down, I've got some room here. Like let's say we maybe form a divergent low point, or maybe even a higher low point. That's okay. If we keep going up, we've got lots of volume above us. In fact, most of the 70% of the volume from the past year is above us. So lots of resistance up here, so I'm not too worried about the move to the upside. And if the bandwidth starts to falter, that means we'll probably just kind of stay in the middle, which is the point of the trade. We just stay in the middle here. We can make up to, for $1,000 of risk, roughly about $500 of reward, which is what I'd be willing to lose out of that $1,000 of risk before I'd close out the trade. So that's our trade idea for today. Alright, well that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new threads there with any questions or comments you have about anything I discussed in today's video. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.